Who remembers the $600 tax rule for CashApp, Venmo, PayPal, and other third-party services? You know, the one that was supposed to start in 2026 and had over 20 million taxpayers absolutely panicking about every single transaction. Well, we just got a massive update to this when President Trump signed the new big beautiful bill, and you're gonna love what just happened. So if you use any payment apps, stay tuned because you need to hear this. Let me explain, starting with chapter number 1, the old $600 rule. The IRS had everyone on edge because starting in 2026, if you got more than $600 through apps like CashApp, PayPal, Venmo, Apple Pay, or Google Pay, these platforms were required to report it straight to Uncle Sam. This rule was introduced under the American Rescue Plan Act, was meant to crack down on underreported income. The IRS wanted to catch freelancers, gig workers, and small business owners who weren't reporting every dime they made through these apps. But here's the thing, it didn't just hit professionals. Even if your buddy paid you $700 for helping them move, or your family sent you cash as a gift, it could get flagged as taxable income. Under the old rule, payment apps had to issue a Form 1099-K to you and the IRS if your transactions for goods and services cross specific thresholds. It started at $5,000 in 2024, dropped to $2,500 in 2025, and was set to hit $600 in 2026. That's right. Just $600. Imagine selling some old furniture for $700 on PayPal. Boom, you get a 1099-K and the IRS is looking at it. If you didn't report it as income, even if it wasn't taxable, you risked penalties, interest, or even an audit. I even had clients worried over this. I'll break down an example later of how messed up the situation really was. But first, let me get to the good news with chapter number 2, the new payment rule. Guess what? The big beautiful bill signed into law on July 4th, 2025 cancels the $600 reporting rule completely. This law is a huge win for small business owners, gig workers, and anyone using payment apps. Trump called it a big, beautiful relief for Americans tired of government overreach. And honestly, after years of dealing with complex tax rules, I'm happy to see this burden lifted. And I'm not the only one. Third-party payment providers like CashApp are also celebrating because the old rule created a paperwork nightmare and tons of confusion. You see, usually gifts and reimbursements are not taxable, but if it was reported to the IRS, then you would have to prove it wasn't income. It was a massive overreach, stressing out millions of honest taxpayers. But I want to hear from you. Let me know in the comments what you think about the new rule changes. Now let's get into the details of what this bill does. First, it scraps the requirement for third-party payment apps to report transactions under $20,000 or with fewer than 200 transactions starting in 2026. That's a massive jump from $600. If you're like James, our freelancer, and you're pulling in $3,000 a year through Venmo, you're off the hook. No 1099-K, no IRS breathing down your neck. Second, the law restores the focus on transactions for goods and services that need to be reported above that $20,000 threshold with 200 or more transactions. Gifts, reimbursements, and personal payments, they're not included in the reporting threshold. The bottom line, this law gives you breathing room. You're not going to get flagged for small transactions anymore, and the IRS isn't going to assume every payment is taxable income. It's a return to common sense. But how does this change things for you compared to before? Let's break down the before and after with chapter number 3, the impact for taxpayers. But really quick before I move on, if we haven't met yet, I'm Sean's clone, a tax professional who personally researches and writes every script you see from me. And while Sean is helping people save on taxes, I'm here to share his knowledge with you. But if you have any questions, the real Sean reads every single comment and tries to respond to most. Also, if you need help with tax planning, click the first link in the description below to get a customized plan before the tax year ends. Moving on to chapter number 3, the impact for taxpayers. Let's quickly go through what this means for you. First, your tax obligations haven't changed. Just because you might not receive a 1099-K form doesn't mean you don't have to report taxable income. If you earned money, you still need to report it on your tax return. The difference is that you won't have to deal with forms that include non-taxable transactions. Second, keep good records anyway. Even though the reporting requirements have been relaxed, it's still smart to keep track of your payment app activity, especially if you're using these platforms for any kind of business purpose. Good record keeping protects you and makes tax time easier. Third, understand the difference between receiving a 1099K and owing taxes. Some people think that if they don't get a 1099K, they don't owe taxes. That's not true. The 1099K is just an information document. Your tax liability is based on your actual income, not on what forms you receive. Fourth, gifts and reimbursements are still not taxable. This hasn't changed. If your friend pays you back for dinner or gives you money as a gift, that's not taxable income regardless of the amount or which payment method they use. Now that you understand that, let's move on to chapter number 5 and review some real world scenarios. I need you to understand how massive these changes are. I'm going to go through 3 examples to really drive home the impact. Example 1, the freelance graphic designer. Meet Mike. He's a graphic designer who does some freelance work on the side. He makes about $300 to $400 per month through various payment apps. Under the old rule, Mike would have hit the $600 threshold by February or March. From that point forward, every payment platform he used would have been tracking his activity. At the end of the year, he might have received multiple 1099K forms showing thousands of dollars in payments. Including that time, his sister paid him back $200 for her share of their mom's birthday gift. Under the new rule, Mike's freelance income is legitimate business activity. But since he makes less than $20,000 per year from it, and assuming fewer than 200 transactions, he won't receive any 1099K forms. He's still responsible for reporting his actual business income on his tax return, but he won't have to deal with the administrative headache of reconciling 1099K forms that include non-taxable personal payments. Example 2, the small business owner. Sarah runs that Etsy jewelry business I mentioned earlier. She makes about $800 per month through PayPal. Under the old rule, Sarah would have received a 1099K by June, showing all her PayPal activity, including any personal payments that happen to go through the same account. Under the new rule, Sarah makes about $9,600 per year, which is below the $20,000 threshold, assuming fewer than 200 transactions. So she won't receive a 1099K at all. She's still responsible for reporting her actual business income on her tax return, but without the added burden of forms that might include non-taxable items. Example 3, the casual user. Tom uses Venmo and CashApp regularly, but isn't running a business. He sells some old electronics occasionally, gets paid back by friends for group dinners, and maybe does some odd jobs for neighbors. Under the old rule, if Tom's total receipts exceeded $600, which could easily happen just from normal social transactions, he would have received 1099K forms that made it look like he was running a business. Under the new rule, unless Tom is clearly engaged in business activity that generates more than $20,000 per year with 200 or more transactions, he won't receive any 1099K forms at all. His occasional sales and reimbursements won't trigger any reporting requirements. The difference is night and day. We've gone from a system that would have ensnared millions of casual users to one that focuses on actual business activity. Here's the bottom line. The elimination of the IRS $600 rule is a big win for taxpayers. What started as a policy that would have created compliance nightmares for millions of people has been replaced with a much more sensible approach that focuses on actual business activity. If you found this breakdown helpful, make sure you're subscribed because we cover tax law changes like this all the time. And if you need help with tax planning or preparation, check out the link in the show notes to get a customized tax plan for you.